Something has changed, and the most dangerous part is that it did not announce itself. There was no single headline that made people stop and say, the rules around moving my own money have changed. There was no national speech. There was no simple letter mailed to every retiree. There was no moment when an ordinary family sitting at the kitchen table could say, now we understand what is different. But over the last 2 years, the practical rules around the old $10,000 bank reporting threshold have changed in ways that can make moving your own money slower, more expensive, more visible, and in some cases much more dangerous than most people realize. I want to be very clear about the principle here. The issue is not that people should hide money. The issue is not that lawful reporting rules should not exist. The issue is that when a rule created in one era is left frozen for more than half a century, while technology, inflation, compliance systems, digital payments, and bank incentives all change around it, the system begins to catch people it was never designed to catch. That is how systems usually become dangerous. Not because one person sits in a room and decides to hurt ordinary families, but because incentives shift, thresholds fail to adjust, software replaces judgment, liability pushes institutions toward overreaction, and ordinary people keep operating under the rules they learned decades ago. That gap between what people think the rule is and what the system is actually doing now is where a lot of pain happens. And for retirees, that gap has become much wider. This is not about a future possibility. It is not about something that might happen someday if a new law is passed. It is about what is already happening in bank branches, payment apps, crypto exchanges, car dealerships, contractors' offices, law firms, and family transactions across the country. If you are over 60, or if you have parents over 60, or if you are handling money for a family member, the old mental model can get you into trouble. You may think you are simply withdrawing cash for a car. You may think you are depositing savings in a careful way. You may think you are reimbursing a family member through a payment app. You may think you are paying a contractor in pieces because that is how the project is progressing, and you may be doing all of it with clean money, honest intentions, and no tax problem at all. But systems do not always begin with your intention. Systems begin with patterns. And once a pattern looks wrong to a bank, a payment platform, a compliance officer, or a government database, you may have to explain yourself after the machinery has already started moving. That is the risk I want to explain. There are 5 ways this old $10,000 world has become much more difficult for ordinary Americans, especially retirees. 1 can delay your withdrawal for up to 3 banking days before you ever touch your own money. Another can turn a series of legal deposits under $10,000 into a structuring issue if the system believes the purpose was to avoid reporting. Another brings crypto and peer-to-peer payments into reporting channels that many older Americans still think of as informal. Another increases the pressure on businesses to report large cash-related payments involving you. And the last is not a change in law at all. It is the unchanged number itself. That is the deepest problem. The number did not move. Everything around it did. To understand how this affects real people, start with a simple story. Imagine a couple I will call Martin and Carol. Martin is 71, Carol is 68. They live outside Phoenix. They are not reckless people. They are not criminals. They are not wealthy in the way people use that word on television. They are comfortable because they worked, saved, lived within their means, and did what families are supposed to do. Martin worked for decades as a regional manager in a paper distribution business. Carol spent her career as a nurse. They know the value of a dollar because they earned their dollars slowly. They decided to replace Carol's car. They did not want financing. They did not want another monthly payment. They had saved the money. They negotiated the price. The final amount was a little over $40,000. So Martin did what millions of Americans would have considered normal for most of their lives. He went to the bank to withdraw the cash. That is when the system stopped being abstract. He gave the teller the withdrawal slip. He expected a routine delay, perhaps a few minutes, perhaps some verification, because $40,000 is not a small amount of cash. But instead of simply completing the transaction, the bank manager asked him to come into a private office. Then the questions began. Why do you need this money? Did someone tell you to make this withdrawal? Have you received calls, emails, or text messages asking you to send money? Have you recently met someone online? Are you sure the person receiving the money is legitimate? From one angle, those are reasonable questions. Elder fraud is real, scams are real, families are destroyed by them. But from Martin's angle, the experience was very different. A competent 71-year-old man who had banked responsibly for decades was being treated as if he needed permission to buy his wife a car. He explained the dealership. He explained the purchase. He explained that nobody was pressuring him. He explained that this was his own money. But the bank still delayed the withdrawal. The delay was up to 72 hours. Think about what that means in human terms. Martin had to go back to the dealership and ask them to hold the car. He had to explain that the money existed, but the bank would not release it yet. He had to deal with the anxiety that comes from discovering, late in life, that access to your own money may depend on a compliance process you do not control. When the cash finally came through, Martin thought the matter was finished. It was not finished. Later, he received notice that a suspicious activity report had been filed. That report does not mean he committed a crime. It does not mean he did anything wrong. It does mean the transaction entered a federal reporting environment and became part of a record that can follow future activity. That is what most people do not understand. The pain is not only the delay. The pain is that the system remembers. Martin and Carol did not rob a bank. They did not launder money. They did not try to hide income. They bought a car. And yet their attempt to use their own money put them into a reporting pipeline that most retirees do not even know exists. This is why the old rule matters. The $10,000 threshold goes back to 1970 under the Bank Secrecy Act. In 1970, $10,000 was a very large sum of money. It could buy things that would cost much more today. It was more than many people earned in a year. It represented a level of cash movement that was unusual for most households. That matters because thresholds are not just numbers. Thresholds are filters. A good threshold separates ordinary activity from exceptional activity. If a threshold is set at the right level, the system spends its energy on transactions that truly deserve scrutiny. But when a threshold is frozen while prices rise for 55 years, the filter breaks. The same number begins catching normal life. A rule that once pointed toward unusual cash movement begins pointing at kitchen remodels, used cars, medical bills, family gifts, insurance proceeds, home repairs, lump sum distributions, and savings transfers. That is how inflation changes the meaning of a law without Congress changing the words. This is one of the most important principles in economics and policy. A static rule inside a dynamic system is not really static. It changes by staying the same. If Social Security benefits adjust for inflation, if tax brackets adjust, if many financial figures move because the value of money changes, but one enforcement threshold does not move, then the practical reach of that rule expands every year. In 1970, the threshold was high enough to capture something unusual. Today, the same threshold can capture ordinary retirement transactions. That is why a retiree can trigger reporting requirements multiple times in a normal year without intending to do anything unusual. A car purchase can do it. A roof repair can do it. A medical expense can do it. A gift to a child or grandchild can do it. A home sale can do it. A pension distribution can do it. A cash settlement can do it. The problem is not that these transactions are illegal. The problem is that they have become visible to systems that often treat visibility as the beginning of suspicion. Once you understand that, the 5 changes make much more sense. The first thing that changed is the senior withdrawal delay. This is the one that affected Martin and Carol banks today are under more pressure to detect elder financial exploitation. That pressure is understandable. Seniors lose enormous amounts of money to scams. A bank that releases money to a fraudster may face lawsuits, reputational damage, regulatory criticism, and moral blame. So the bank has an incentive to stop questionable withdrawals. But incentives matter. When the bank faces risk for releasing money and almost no risk for delaying money, the system naturally leans toward delay. That does not mean every banker is trying to mistreat seniors. It means the system rewards caution more than speed. A bank employee may know you, a branch manager may believe you, but compliance rules, software alerts, and legal departments can still push toward freezing or delaying a transaction. The key phrase is reasonable suspicion to the average person. Reasonable suspicion sounds like someone noticed actual fraud, maybe a strange phone call, maybe a romance scam, maybe a threatening email, maybe a grandson in trouble. But in a compliance environment, suspicion can begin with something far simpler, a deviation from your normal pattern. If you usually withdraw a few $100s and suddenly request $12,000, that is a deviation. If you rarely use wire transfers and suddenly send a large one, that is a deviation. If you have not moved cash for years and suddenly ask for a large withdrawal, that is a deviation. The system does not know your reason. It does not know your story. It sees the pattern first. Then a human may review it. That review may take hours. It may take days. During that window, the bank may not release the funds. And here is the painful part. The bank does not necessarily have to explain the process in plain language. You may hear that there is a processing issue. You may hear that compliance needs to review it. You may hear very little from your perspective. Your own money is paused. From the bank's perspective, it is reducing risk. Those two perspectives collide most often when an older person needs money quickly for a legitimate reason: a car purchase, a medical bill, a family emergency, a contractor deadline, a home repair. The next thing that changed is the structuring trap. And this one is more serious because it can create legal danger even when the money itself is perfectly clean. Structuring means breaking transactions into smaller pieces for the purpose of avoiding a reporting requirement. This is where many honest people make a dangerous mistake. They think the report is the danger. They think crossing $10,000 is bad, so they try to stay under $10,000. That is exactly backward. A report is usually just a report. Trying to avoid the report can become the problem. If you need to move $12,000 and you move it as $12,000, the bank may file whatever report the law requires that may be inconvenient. It may feel uncomfortable, but the transaction itself is straightforward if instead you split it into $6,000 and $6,000 because you want to avoid the report. You may have created the pattern the system is designed to catch. That is the dangerous principle. The law is not only concerned with dirty money, it is concerned with the intent to evade reporting. Clean money can still be involved in a structuring problem if the pattern suggests you deliberately broke it up to avoid the threshold. For decades, people associated structuring with very obvious patterns. Someone walks into a bank several days in a row depositing $9,500. Someone repeatedly withdraws $9,900. Someone keeps transactions just under the line. That is still dangerous. But modern detection does not only look for the most obvious behavior, it looks for clusters, it looks for timing, it looks for amounts below the threshold, it looks for repeated patterns. It looks for behavior that may suggest the person knew the threshold and tried to maneuver around it. This is where ordinary retirees can get caught. A retired person may have cash from a legitimate source. They may deposit it in smaller amounts because they are cautious. They may think smaller deposits look less suspicious. They may be trying to stay below a number because they heard about the $10,000 rule years ago. They may not understand that the attempt to avoid the report is the conduct that creates risk. Then a bank's software flags the pattern. A human review follows. A suspicious activity report may be filed. That report can move into databases and, in some cases, lead to further review. In the worst cases, accounts can be seized through civil asset forfeiture even where criminal charges are never filed. That is not a theoretical point. Public interest lawyers have documented cases where ordinary business owners had money seized because their legal deposit patterns were interpreted as structuring. A family grocery business on Long Island had hundreds of thousands of dollars seized after making repeated deposits under $10,000. Their stated reason involved cash handling and insurance limits, not crime. But the pattern looked like evasion to the government, and they had to fight to get their money back. A dairy farmer in Maryland faced a similar kind of seizure. A convenience store operator in Iowa lost tens of thousands of dollars overnight. The lesson is not that every small deposit is illegal. The lesson is that patterns matter, intent matters, and documentation matters. If your pattern looks like evasion, you may be forced to explain yourself after the fact. That is a very bad position to be in. The third thing that changed is that digital payments are no longer outside the same reporting psychology. Many older Americans still think of digital payment apps as informal. Zelle feels like sending money to family. Venmo feels like splitting dinner. Cash App feels like a quick transfer. PayPal feels like a convenience. Crypto feels like a separate world, but the reporting environment has been moving toward greater visibility across these systems. Payment platforms, exchanges, and apps increasingly create records that can be reported, matched, reviewed, and compared with tax filings. That does not mean every family reimbursement is taxable. It does not mean every transfer is income. But it does mean that the old mental separation between banking and apps is not safe. If money moves digitally, it creates a trail. If it crosses certain reporting thresholds or looks like business activity, it may generate a form. If the form says one thing and your tax return says nothing, the system may ask questions. This is especially confusing for retirees because many of them use the same app for many different purposes. A child reimburses them. A church pays them back for an event. A neighbor buys an old piece of furniture. A grandchild sends money for a shared dinner. A hobby sale comes through the same account. A small side activity gets mixed into personal transfers. The issue is aggregation. When personal and quasi-busyness transactions are mixed together, the totals can look like income even when part of the money is just reimbursement. The system may not understand context, it sees amounts, it sees payers, it sees frequency, it sees a platform. Then a form may be generated or a review may be triggered. The burden shifts to you to explain what was personal, what was business, what was reimbursement, what was a gift, and what was taxable. Again, the principle is the same. The system sees the pattern before it hears the story. Crypto adds another layer because exchanges increasingly report customer activity and large transactions may interact with bank reporting expectations. The average person may think of crypto as outside the old cash rules, but that assumption has become much less safe. The point is not that people should avoid digital payments. The point is that digital convenience has reduced friction while increasing visibility. You can move money in seconds, but you may spend hours later explaining what those seconds meant. The fourth thing that changed is the growing importance of Form 8300 and the pressure it puts on businesses that receive large cash-related payments. Most consumers do not think about this form because it is filed by the business, not by them. That is exactly why it surprises people. If you pay a car dealer, a contractor, a lawyer, a jeweler, a boat dealer, or another business more than $10,000 in cash or certain cash-like instruments in one transaction or related transactions, the business may be required to file a report identifying you and the nature of the transaction. From your point of view, you are just paying a bill. From the business's point of view, they have a filing obligation. And when penalties for missed, late, inaccurate, or intentionally disregarded filings become more costly, the business has a very strong incentive to file. That incentive is rational. The business does not want to take risk for you. If there is any doubt, the safer choice for the business is to file the form. This is another place where ordinary behavior creates unexpected reporting. You pay a contractor $12,000 for a roof, you buy a used vehicle in cash, you give a cashier's check to an attorney for a retainer, you split payment for one project into pieces. You may think that because no single payment crossed the line, no report applies, but related transactions can be aggregated. If the two payments are part of the same roof repair, the same car purchase, the same legal matter, the same business transaction, the system may treat them as one. And if you split them because you thought that would avoid reporting, you have again moved toward the structuring problem. This is one of the most dangerous misunderstandings in personal finance. People often fear the report, but the safer path is usually to accept lawful reporting and keep clear records. The risk rises when you try to make the report disappear by changing the pattern. That may feel clever in the moment. It can look suspicious later. The fifth thing that changed is the inflation cascade. This is the biggest one because it explains why all the others now hit ordinary people. The world has changed. The price of normal life has changed. Retirement transactions have changed. The threshold did not. Think about the practical life of a retiree. A couple sells a second home, a widow receives a life insurance check, a family helps a grandchild with a down payment, a retiree pays off a mortgage, someone replaces a car, someone remodels a bathroom, someone pays a medical bill insurance did not fully cover, someone receives a lump sum distribution after a spouse dies, someone moves money from one institution to another. None of this is exotic. None of this is criminal. This is ordinary retirement life. But ordinary retirement life now crosses $10,000 again and again. That means the average retiree can be reported, reviewed, delayed, or documented repeatedly without ever doing anything that feels unusual. This is how a compliance state expands without people noticing. It does not require a dramatic new law every week. It only requires old thresholds, higher prices, better surveillance, stronger software, and institutions that prefer over-reporting to under-reporting. When those forces combine, the system becomes broader, it becomes faster, it becomes more automatic, it becomes less personal. And when a system becomes less personal, you need a better process. This is the important part. The answer is not panic. The answer is not hiding. The answer is not breaking transactions into pieces. The answer is not trying to outsmart a system whose software has more memory than you do. The answer is to act like a careful operator inside a complicated machine. You need preparation, you need documentation, you need clear intent, you need to reduce ambiguity before the system turns ambiguity into suspicion. The first protection move is to pre-notify your bank before a large transaction. This is simple, and because it is simple, many people underestimate it. Before you make a large withdrawal, deposit, or transfer, especially one that is unusual for you, contact the branch manager or the bank's appropriate department. Explain what the transaction is. Explain the source of the funds. Explain where the money is going. Ask that a note be placed in your customer file before the transaction occurs. This does not make reporting requirements disappear. If the law requires a report, the report will still be filed. But it can reduce the chance that your money is delayed because the bank does not understand what is happening. The system flags deviations. A good note helps explain the deviation before it becomes a problem. If Martin had pre-notified the bank about the car purchase, the experience might have been very different. The bank still may have asked questions, the withdrawal still may have been reviewed, but the context would have been available before he was sitting in the office trying to defend his own competence. The second protection move is to stop accidentally structuring. If you need to move a large amount, do not split it into smaller pieces simply to stay under $10,000. That is the core rule. If you need to move $12,000, moving $12,000 with a clear purpose is usually less dangerous than moving $6,000 twice because you are trying to avoid a report. If payments are separated because the actual business purpose is separate, keep records showing that if the contractor bills in stages because the work is completed in stages, keep the invoices. If a family transfer happens in more than one part because funds became available at different times, write that down. The point is not that every split payment is wrong. The point is that the reason for the split must not be evasion of the reporting threshold, and if you have to explain it later, your documentation should show a legitimate reason. The third protection move is to use wires or traceable institutional transfers for large transactions when appropriate instead of large physical cash movements. Cash is emotionally satisfying for some people because it feels final. But cash is also the center of many reporting rules and many bank concerns. Large cash withdrawals, especially from senior accounts, can trigger fraud reviews. Large cash payments can trigger business filing requirements. Physical cash creates security risks, counting risks, and suspicion risks. A wire to a car dealer, an attorney, a contractor, or another legitimate recipient may be cleaner. It creates a traceable path. It reduces cash handling. It may reduce the business's concern about cash-related reporting, and it may reduce the bank's fear that you are being coached by a fraudster to withdraw physical cash. This does not mean wires are invisible. They are not. The goal is not invisibility. The goal is clarity. In a world of automated compliance, clarity is much more valuable than cleverness. The fourth protection move is to separate digital payment accounts by purpose. Do not mix family reimbursements, hobby sales, side income, church reimbursements, and personal transfers into one messy stream if you can avoid it. If an account is personal, keep it personal. If an account is used for selling items, consulting, hobby income, rentals, or any activity that may look business-related, separate it. That way, when a form is generated or a tax question arises, you are not forced to reconstruct a year of mixed transactions from memory. Many people create their own problems by blending money streams. Then they are surprised when the system blends them too. A clean system makes clean explanation possible. A messy system forces you to defend yourself with weak records. The fifth protection move is to build a documentation habit before you need it. This may sound boring. It is not boring when your account is frozen. It is not boring when a transaction is questioned. It is not boring when a reviewer asks why you made several deposits in a certain pattern. For every meaningful transaction, especially over a few $1,000s, keep a simple record: date, amount, source, recipient, purpose, supporting documents. A notebook is enough. A spreadsheet is better. A folder with receipts, invoices, sale agreements, banknotes, and emails is better still. The goal is not perfection. The goal is contemporaneous evidence. You want a record created at the time of the transaction, not an explanation invented 6 months later under pressure. In disputes involving structuring, forfeiture, or suspicious activity, timing matters. If you wrote down the reason before anyone questioned you, that record is stronger than a story you tell after the money is already frozen. There is one more move that matters, especially for seniors. It is a senior safe banking authorization or a similar arrangement with your bank. Different banks may call it different things. The principle is that you identify trusted contacts and expected transaction categories before a problem happens. You tell the bank in advance what kinds of large transactions are normal for you: car purchases, medical expenses, home repairs, family gifts, other retirement, related movements. You identify a trusted person the bank can contact if there is concern. You ask how the bank handles elder fraud reviews and whether they can place standing instructions or notes in your profile. This does not give away control of your money. It gives the bank context, and context is what the automated system lacks. Most retirees wait until the first freeze to have this conversation. That is too late. The right time to define the relationship is before the transaction creates stress. That is the broader principle in everything I am saying. Do not wait for the machine to misunderstand you. Design your process so it has fewer chances to misunderstand you. That is how I think about risk. Risk is not only what is likely. Risk is what can happen if a low probability event meets bad preparation. A 72-hour freeze may be a small inconvenience if you are moving money with no deadline. It can be a major problem if a car is being held, a surgery must be paid for, or a contractor is waiting to start work. A suspicious activity report may be invisible most of the time. It can matter if future transactions create more flags. A digital payment form may be simple if your accounts are clean. It can become a mess if you mixed personal reimbursements with side income all year. A split payment may be harmless if it reflects real project stages. It can become dangerous if the pattern looks like avoidance and you have no documentation. That is how small decisions become large problems. Most families do not get hurt by one catastrophic decision. They get hurt by a chain of ordinary decisions made under outdated assumptions. The outdated assumption here is that the $10,000 rule is just an old bank rule that only affects criminals or people carrying bags of cash that may have been closer to reality decades ago. It is not a safe assumption. Now today, the threshold touches normal life because normal life has become more expensive. It touches retirees because retirees often move larger sums less frequently. It touches families because family assistance often involves large transfers. It touches small businesses and contractors because payment rules are stricter and penalties matter. It touches digital apps because platforms create records and reports. It touches banks because their liability for scams makes them cautious. When all of that combines, the practical rule becomes this: your money can be yours and still not move the way you expect. That is the part people need to internalize. Ownership and immediate access are not always the same thing. A bank account is a claim inside a regulated system. When the system sees risk, it can slow the movement of that claim. You may ultimately get the money. You may prove everything. You may have done nothing wrong. But the delay, the stress, the reporting, and the burden of explanation can still fall on you. That is why preparation is not paranoia. It is good operating procedure. Call before large transactions. Do not split payments to avoid a threshold. Use traceable institutional methods where they fit separate digital money streams. Document meaningful movements. Set up senior banking protections before the first problem. Those are not tricks. They are ways of reducing ambiguity, and in a system that punishes ambiguity, reducing ambiguity is one of the most rational things you can do. I want to close with the most important lesson. The $10,000 rule is not becoming simpler. It is becoming broader in practice because money is worth less. Transactions are bigger, software is stronger, and institutions are more defensive. It is easier than ever for the system to see your money. It is harder than ever for the system to understand your intention. So you must make your intention visible before somebody else defines it for you. That is the real shift. In the old world, you could often rely on relationship, common sense, and a banker who knew your name. In the new world, you need process, you need records, you need advanced communication. You need to understand that the compliance system is not built around your personal story. It is built around patterns, thresholds, reports, and incentives. If you are a retiree with meaningful money moving through your accounts, you cannot afford to treat this as something that only happens to other people. Martin and Carol were other people until the bank manager asked Martin to step into the office. The grocery store owners were other people until their account was seized. The farmer was another person until operating money disappeared. The convenience store owner was another person until the pattern became a case. You do not have to be frightened. You do have to be awake. The safest person in this system is not the person who tries to hide. It is the person who moves money plainly, documents it clearly, communicates in advance, and never lets an outdated rule turn a normal transaction into a suspicious pattern. That is the principle. Do not try to beat the machine. Make the truth easy for the machine and the people behind it to see. Because the next time you need to move a meaningful amount of your own money, the difference between delay and release may not be whether the money is yours. It may be whether you prepared the system to understand why it is moving.